call. All participants will be in a listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star then 1 on your touch-tone phone. And to withdraw your question, please press star then 2. Please note this event is being recorded. I would now like to turn the conference over to Ms. Alexandra Johnstone, Vice President of Finance and Investor Relations. Please go ahead, ma'am.
Thank you for joining us on our first quarter 2026 earnings call. During this call, we will make certain statements that may be deemed forward-looking within the meaning of the Safe Harbor of the Private Securities Litigation Reform Act of 1995, including statements regarding projections, plans, or future expectations. Actual results may differ materially due to a variety of risks and uncertainties set forth in today's earnings results and supplemental and our SEC filings. Reconciliations of non-GAAP financial measures to the most directly comparable GAAP measures are included in the supplemental filed on Form 8-K with the SEC, which is posted in the investor section of the company's website at MACERICH.com. Joining us today are Jack Hsieh, President and Chief Executive Officer, Dan Swanstrom, Senior Executive Vice President and Chief Financial Officer, and Doug Healey, Senior Executive Vice President of Leasing. And with us in the room is Brad Miller, Senior Vice President of Portfolio Management. With that, I would like to turn the call over to Jack.
Thanks, Alexandra, and good afternoon, everyone. I'll give some brief comments on the quarter, followed by an update on our leasing progress against our Path Forward plan, some context on what we're seeing in Class A regional malls, and discuss our recent acquisition of Annapolis Mall. Our first quarter results reflect the continued progress we're making on our Path Forward plan. Our FFO, as adjusted per diluted share, was 34 cents. For our Go Forward portfolio, sales per square foot increased to $941. Total comparable inline sales increased 3.9% from Q1 2026 versus 2025, and foot traffic was slightly up. Go Forward portfolio centers NOI growth was 1.2%. One of our primary goals with the Path Forward plan is to elevate and transform the merchandising plan and mix of our centers through the leasing of 1,000 new units, which will create thriving retail centers with increased customer traffic, dwell time, and result in improved productivity for our tenants. This leasing strategy enables us to mark-to-market the rents in our retail portfolio, enabling us to create $140 million of cumulative SNO, the signed, not open tenant pipeline, that will drive our property NOI through 2028. And coupled with our $2 billion disposition plan, we believe will result in higher FFO per share and lower corporate leverage. Our cumulative SNO pipeline at the end of Q1 was $116 million against our $140 million target. That is contracted revenue with approximately 80% flow through to NOI. That is multi-year growth engine that will provide the NOI ramp through 2028. Leasing our temporary vacant and below-market inline and vacant anchor spaces remains one of the critical elements of our Path Forward plan, as the new 1,000 leases represents almost 25% of the entire space units within our Go Forward portfolio. Our leasing speedometer, which tracks revenue completion, was at 81% at the end of Q1 and currently stands at 83%. We only have 250 remaining leases to complete the plan, of which 125 leases are currently in the LOI phase and 125 units are in the prospecting phase. These remaining space units are primarily situated within our Fortress fortress potential assets in A, B, and C rated spaces. Our ELC approval quarterly run rate has averaged 100 deals per quarter. In Q1, we approved 103 new lease transactions. Based upon our new lease approval run rate and the remaining 250 deals that need to execute, I'm confident we will substantially complete our leasing target by year-end. As I now have passed my two-year tenure here at MACERICH, I've gained more confidence and belief in the resurgence of Class A regional malls and their ability to consolidate trade areas and to become even more relevant to customers and tenants. The mall industry has had to battle decades of overbuilding, the Amazon effect, anchor store closures, and major inline tenant consolidation and bankruptcies, the global financial crisis, and COVID. It's wreaked havoc on the U.S. mall industry, where only 895 enclosed malls currently remain. The silver lining today is that tenants have seen a demonstrated improvement in their omni-channel strategies with good physical stores. There has been a lack of new store expansion until most recently. Retailers' preference has been a growth strategy of quality versus quantity, large flagship and high-quality built-out physical stores versus historical market saturation strategies in the past. But the 236 Class A regional malls today, we have multiple strategies and targets for anchor tenants. Numerous inline, international, domestic, and experiential tenants that can drive customer traffic to our centers. We have a high-quality, irreplaceable portfolio with 90% of our NOI from Class A malls. Gen Z shoppers today are another long-term tailwind for us, as that cohort over-indexes in visiting physical stores, spending money on items, food, and experiences. By 2040, Gen Z will be the largest spending demographic, surpassing millennials and Gen X. I recently created a Gen Z committee within our company. Their focus is on helping us gain insight on how to transform and elevate our centers through winning loyalty of the Gen Z customer without losing the current dominant millennial and Gen Xers that visit our centers. Executing our Path Forward leasing strategy will result in physical permanent occupancy increasing from 84% to 88 to 89%, which will enable us to have more pricing power and ability to further elevate and transform our centers. To give you a specific example of this later stage transformation, at Scottsdale Fashion Square, we replaced a 35,000 square foot home furnishing tenant with luxury and dining options, including Hermes, Elefante, and Loro Piana. Cost of occupancy on the new spaces increased more than 10 times. Sales are also projected to increase more than 10 times to over $100 million. Backfilling our 30 vacant anchors is also critical to our elevate and transform strategy. We have all 30 of these locations committed, over 2.9 million square feet, that is expected to generate over $750 million in sales. More importantly, these are catalysts to unlock productivity in entire mall wings and drive inline leasing. The Scheels Sporting Goods store at Chandler is a perfect example of the success of this strategy. Since Scheels' opening in late 2023, the Chandler Mall trade area has increased over 40%, and overall traffic at the center is over 20%. Prior to Scheels opening in a vacant Nordstrom store, that mall wing had inline vacancy and less relevant tenancy. Today, not only has the Scheels wing dramatically elevated, the entire center is experiencing elevated tenancy and transformation. Lululemon expanded and relocated their store. Other new store openings include Warby Parker, Travis Matthews, JD Sports, Fiore, James Avery, Gloriana, Swarovski, Levi's, Garage, Din Tai Fung, and many other exciting brands to be announced soon. Green Street upgraded our Chandler asset from A- to A, and their cap rate valuation compressed 100 basis points. That's the playbook that we're executing across 30 similar projects. Dick's House of Sport recently opened at Freehold Raceway Mall, and that center has experienced increased traffic and vibrancy in the former vacant Lord & Taylor wing, and is enabling us to leverage more leasing throughout the center. Most recently, we executed a deal with Von Maur to locate in the former Nordstrom building. We currently have 10 committed Dick's House of Sport stores in our anchor store inventory. Before I comment on our recent Annapolis Mall acquisition, I want to share a quick update on Crabtree Mall. We have already made improvements in the common area and are currently addressing our pre-planned CapEx. We have completed 36 new and relocation lease deals and 27 renewals. The Raleigh-Durham MSA is on many tenants' target lists, given the growth and health of the trade area, and Crabtree is continuing to gain market share as we have implemented the Elevate and Transform strategy. Annapolis Mall has similar positive green shoots like Crabtree Mall. The difference is that the prior owners successfully started the Elevate and Transform process 2 years ago. Last week, we closed on the mall acquisition for $260 million, plus $12 million for the 13.1-acre vacant Sears parcel. This is a Class A regional mall with 1.5 million total square feet in one of the most affluent markets on the East Coast. Average household income over $161,000 in the primary trade area, and a total trade area population of over 1 million. Over the past 2 years, the prior owners were able to secure a Dick's House of Sport that is opening later in August and signed 18 new tenant deals, totaling 353,000 square feet, opening in 2026 and 2027, including Dave & Buster's, Tesla, Uniqlo, Aeropostale, Abercrombie, Jack & Jones, Pop Mart, a Lululemon relocation and expansion, plus recent long-term renewals with Apple, Zara, and AMC. Annapolis Mall's proximity to the dominant Tysons Corner Mall extends our platform, creating a more influential portfolio that will benefit from our ability to lease up the remaining 107,000 square feet of near-term available space, including 52,000 square feet of prime inline space in the new Dick's House of Sport wing. We are currently exploring backfill opportunities for the vacant Sears parcel. It sits on the most heavily trafficked corner of the property and provides optionality for future retail, mixed use, or alternative development. The acquisition is accretive to our 2028 target FFO range under our Path Forward plan by approximately 4 cents per share on a leverage-neutral basis. We expect year one NOI, including SNO, of approximately $29 million, projected to stabilize in the $33 million area. That's an initial yield of 10.5%, increasing to 11% plus at stabilization. The asset is in good physical condition and does not require significant capital to address deferred maintenance. We funded the acquisition with cash on hand, which includes $85 million of ATM equity at an average price above $19 and $150 million of borrowings on our line of credit. As I look forward, we are well on the way to completing our Path Forward plan. The finish line is in plain sight. I have a high degree of confidence in achieving our 2028 operational and financial targets. No one is building new Class A regional malls, and the leasing demand is evident. We operate in affluent supply-constrained markets, and approximately 90% of our Go Forward NOI comes from Class A properties. We believe the structural tailwind of expanding retailers, coupled with the burgeoning Gen Z demographic, will be a continued positive factor for our business over the next decade. When we come out on the other side of this plan, we believe you're going to be looking at a company with 88 to 89% physical permanent occupancy, embedded annual rent escalators across our portfolio, a balance sheet with lower leverage, strong free cash flow generation, and a portfolio of irreplaceable assets in affluent markets with the most relevant retailers in place. We look forward to providing an update on Path Forward 3.0 at MACERICH in June. With that, I'll turn it over to Doug.
Thanks, Jack. First quarter reflects continued leasing momentum across our portfolio. Portfolio sales at the end of the first quarter were $899 per square foot, up $18 when compared to the last quarter, representing a new high water mark for the company. When you look at our Go Forward portfolio, sales were $941 per square foot, underscoring the strength of our elevation strategy and long-term rent growth opportunity. Occupancy at the end of the first quarter was 93.4%, down 60 basis points sequentially. This seasonal decline is consistent with prior years as temporary tenants typically vacate during the first quarter. The Go Forward portfolio occupancy at the end of the first quarter was 94.5%, reflecting strong underlying demand for space in our best centers. In the first quarter, we opened 225,000 square feet of new stores. Most notably, we opened 2 new restaurants in the Nordstrom luxury wing at Scottsdale Fashion Square, Din Tai Fung and Teleferic Barcelona. This is our second store with Din Tai Fung and first with Teleferic Barcelona. Teleferic is a first to Arizona family-owned contemporary tapas restaurant, actually originating in Barcelona. Din Tai Fung and Teleferic joined well-established concepts such as Elefante, Catch, Society Swan, and our restaurant leasing in this wing is now complete. These restaurants have opened to tremendous fanfare, and all are exceeding our goals and expectations, reinforcing the role of high-quality food and beverage as a key traffic driver in luxury assets. We also opened a 10,000 square foot Aritzia store in Los Cerritos. Aritzia is one of the most sought-after retailers in North America and a great catalyst as we elevate the merchandising mix in this center. This is our 8th store with Aritzia, and we expect to grow this relationship as the brand expands its store fleet and increases its open-to-buys. Leasing activity remained strong throughout the first quarter. In total, we signed 1.6 million square feet of new and renewal leases, of which 700,000 square feet were new deals, more than double the amount of new leasing we completed in the first quarter of 2025. As Jack highlighted, backfilling vacant anchor space is critical to our transformation strategy. During the quarter, we signed 3 more anchor tenants: Dick's House of Sport at Los Cerritos, Round One at Washington Square, and Von Maur at Freehold Raceway Mall. For those less familiar with Von Maur, it's a family-owned upscale department store founded in the late 1800s in Davenport, Iowa. It's still headquartered there and run by the Von Maur family. Von Maur is known for its exceptional service, premium brands, and high-quality build-outs. Von Maur's 145,000 square foot store is currently under construction and will open in the third quarter of 2027. Von Maur, along with the recently opened Dick's House of Sport, will play a key role in transforming and elevating the merchandise mix at Freehold. We're also excited to announce our first deal with Fogo de Chão, which will open in the redevelopment area of Green Acres Mall. This 7,500 square foot Brazilian steakhouse is a globally recognized brand with more than 70 locations nationwide. Fogo de Chão has successfully evolved into a first-class contemporary dining concept that will strongly resonate with our young customers. Fogo de Chão is scheduled to open in 2027, and we look forward to announcing additional locations with this brand across our portfolio in the very near future. Turning to our lease expirations, we have commitments on approximately 90% of 2026 expiring square footage that is expected to renew and remain open, with another 10% in the letter of intent stage. As a result, we're effectively done with 2026 and now actively focused on 2027 and 2028. In fact, as we look specifically at our 2027 expirations, we're 30% committed with another 55% in the letter of intent stage. These are critical milestones that significantly de-risk the renewal component of our 5-year plan. Retailer environment is healthy, and tenant demand continues to be strong. In the first quarter of 2026, we reviewed and approved roughly the same number of new deals as we did in first quarter 2025. And keep in mind, 2025 was a record leasing year for us. Supported by our enhanced internal leasing processes, we now have clear insight into what's next across our portfolio. Letters of intent remain a key leading indicator of future leasing activity, and based on both volume and velocity, we expect this strong momentum to continue throughout the remainder of the year. Lastly, we're looking forward to the Las Vegas ICSC convention in mid-May, where we expect strong retailer attendance and a highly productive environment. Over the course of 3 days, we have more than 300 scheduled meetings with 250 different retailers, spanning legacy retailers, international retailers, entertainment and experiential concepts, food and beverage, health and wellness, and emerging brands. We are confident that the activity coming out of this convention will translate into incremental leasing growth, which will continue to strengthen our already robust leasing pipeline. And with that, I'll turn the call over to Dan to go through our first quarter financial results.
Thanks, Doug, and good afternoon. I'll start with a review of first quarter financial results. FFO, as adjusted, was approximately $92 million or 34 cents per share during the first quarter of 2026. I would like to highlight the following item included in our FFO as adjusted for the quarter. Total gain on undepreciated asset sales of approximately $10 million, resulting primarily from the sale of a land parcel at Washington Square. Go Forward Portfolio Centers NOI, excluding lease termination income, increased 1.2% in the first quarter of 2026 compared to the first quarter of 2025. Winter weather, which resulted in higher snow removal and related expenses at our East Coast properties, negatively impacted our NOI growth by about 50 basis points. As a reminder, we expect Go Forward Portfolio Centers NOI growth for the full year 2026 to be up at least 3% over 2025 and back-end weighted in terms of NOI growth contribution for the year. We then continue to expect Go Forward NOI growth to accelerate meaningfully from there in 2027 and 2028 as the snow pipeline tenants open and begin paying rent. As Jack mentioned, we have a high level of confidence in achieving the total snow opportunity of approximately $140 million. The estimated annual contribution is $30 million in 2026, back-end weighted, $40 to $45 million in 2027, and $45 to $50 million in 2028. This represents a clear, visible path to drive incremental growth. Turning to the balance sheet, we continue to make strong progress on the balance sheet initiatives contained in our Path Forward plan. 2026 has already been an incredibly productive year by the team in relation to our various financing activities. In February, we closed on a 4-year loan extension through November 2029 on our South Plains property. This $200 million loan extension was completed at the existing interest rate of approximately 4.2%. With respect to our 29th Street property, this $76 million loan at the company's pro rata share remains in default after its February maturity date. As we are currently in discussions with the lender on the terms of this loan, we do not have any additional commentary at this time. Also in February, we closed an amended and restated $900 million revolving credit facility. We increased the size of the facility from $650 million to $900 million, extended the maturity date from January 2027 to March 2030, and lowered the current pricing grid from a spread range of 200 to 250 basis points over SOFR to 180 to 220 basis points over SOFR. The current spread is 190 basis points over SOFR. Upon achievement of certain performance thresholds, those spreads will be further reduced to a range of 135 to 165 basis points over SOFR. We are very pleased with the execution on this new facility, and we appreciate our bank group's support of MACERICH and its Path Forward plan. In March, we repaid the outstanding balance of approximately $212 million on Vintage Fair Mall with cash on hand and $100 million of borrowings on the line of credit. At Deptford Mall, subsequent to quarter end, our joint venture closed on a new $115 million 5-year mortgage loan. This new loan bears interest at a fixed rate of 6.95% and is interest only during the entire loan term. This execution and interest rate are consistent with what we had assumed for Deptford in our Path Forward plan refinancing assumptions. We're continuing to proactively address our remaining 2026 debt maturities through a combination of potential asset sales, refinancings, loan modifications, or if necessary, property givebacks. We currently have approximately $780 million in liquidity, including $650 million of capacity on our revolving line of credit. From a leverage perspective, net debt to adjusted EBITDA at the end of the first quarter was 7.76 times, which is a full turn lower than at the outset of the Path Forward plan. And importantly, we've outlined our strategy to further reduce leverage to the low to mid 6 times range over the next couple of years. We are making substantial progress in executing on dispositions as part of our Path Forward plan. During the first quarter, we closed on the sale of various outparcels and land for approximately $15 million, which included the land parcel at Washington Square. To date, we have completed approximately $1.3 billion in total dispositions, representing about 2/3 of our initial disposition target, and the disclosure we've provided in our supplement includes a summary of these asset dispositions. These sales transactions are consistent with our stated disposition plan to improve the balance sheet and refine our portfolio. Based on our current level of discussions, marketing activities, and contract negotiations, we currently expect to sell or give back $300 to $400 million of additional EDDI assets, outparcels, and land by the end of this year. This would increase total dispositions up to approximately $1.7 billion. The ongoing and remaining sales, primarily related to certain outparcels and land, are likely to carry over into 2027 as we continue to work through various entitlements, reparcelizations, and lender-related activities. These items simply just take some additional time to complete, and we will remain disciplined in our execution to maximize sales proceeds and shareholder value. We'll provide further updates on our disposition activities as we progress through the year. Overall, we are making great progress on our Path Forward plan objectives to reduce leverage, refine the portfolio, and strengthen the balance sheet. With that, we'll turn the call over to the operator.
Thank you. We will now begin the question and answer session. To ask a question, you may press star then one on your touch-tone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. If at any time your question has been addressed